We have a better picture for risk assets this morning. And just to underline that, I want to just mention that we've had a headline on UK natural gas prices. So UK natural gas futures dropping as much as 17%. That's on the ICE index. So a sense that maybe we're continuing with some of that drop back that we saw yesterday on the European gas narrative because of what Russia has had to say. So there's that. There's the debt ceiling in the US. This rebound in risk assets then that we're seeing today. Do you sense that it has legs, Myles?
Yeah, there's a lot going on, isn't there? And I think it's important to separate the trend, the underlying macro conditions with all these short-term noise that we're getting in terms of gas prices soaring, then plunging back. The fundamentals of the economy are good. You know, we've got strong household and corporate balance sheets. We're likely to have a gradual withdrawal of monetary and fiscal support, which is, evidenced by your story you've got on the ECB merging the PEP and APP. And this is supportive for risk assets broadly, yes. So, if I look at my portfolios, the outlook is we expect corporate defaults to remain low. We expect corporate earnings to be good. This is a market where we want to be owning higher risk assets such as high yield and European bank capital.
Myles, what about inflation expectations becoming baked in? We saw this, of course, with the break-evens yesterday here in the UK. We saw gilts higher, comfortably above 1% then. A similar picture, of course, across many of the German benchmark sovereign bonds. Are you concerned about baked-in inflation expectations and what that may mean then for earnings longer term?
This is the key risk because, we've had temporary inflation shocks, particularly in the UK with utility prices before. But it hasn't become embedded in inflation expectations. And the UK is one market where inflation expectations have shot up. And that's partly to do with Brexit in particular and concerns about labour supply. So it's one thing that we are watching very carefully, because if inflation expectations shoot up, it means that you can't have the gradual withdrawal of monetary support that the economies need in order to support growth. My own view is that, it's unlikely we're going to get a de-anchoring of inflation expectations in places like the US and the Eurozone. And indeed, even in the UK, you're seeing the central bank beginning to react to rising inflation expectations. So I think when we look at inflation expectations in the market, we've got to remember that not only does that include expectations, it also includes inflation risk premia. And clearly, inflation risk premia is on the upside. And that's what I think the market is signaling here. That's the risk to the market.
Inflation risk premium to the upside, Myles. What does all of this mean then in the UK context? As you mentioned the UK there, what does it mean in the UK context as the markets increasingly factor in an interest rate hike here in the UK this year? We've seen it from some central banks in Norway and in New Zealand. Is the UK the next one to go? And would that be the right move for the central bank? Because the central bank governor has told us many times himself that there are various factors pushing up inflation that monetary policy can't solve. Monetary policy can't make more chips get to the right places more quickly.
This is a problem you've seen in other places. Poland yesterday rose rates unexpectedly, or in terms of market expectations. You've seen it in Hungary, you've seen it in Chile. So I think there's a number of things going on. Firstly, you've got rising inflation expectations, which is a concern. You've got high levels of inflation, which also is a concern because that feeds inflation expectations. But in all these situations, what you've also got is a very strong labour market. And I think the Bank of England situation is furlough has ended. The expectations was that unemployment would increase. You haven't seen a pickup in redundancies as furlough has ended, and so that gives the bank more confidence. The labour market is actually quite strong. Inflation expectations are high. It seems sensible that they start to withdraw the stimulus that they've given the economy, yes. I think the Bank of England and the UK is one of the more vulnerable economies to so-called stagflation, and that's because of Brexit and how Brexit has made the economy more fragile because it's broken the flexible labour market that we used to have. So I think the UK is slightly different than if you look at the Eurozone, for example, where they haven't had the same disruption caused by Brexit.